Okay, let's take our analogy and our information on systemic and unsystemic risk and turn it into the market equilibrium, the capital market line. And as you can see here, we've got return of the vertical axis, of course, your standard deviation along the horizontal axis, and we have the market portfolio as represented as M here at the tangent of the capital market line and the risk-free rate. And what it says is, with the capital allocation line identified, all investors choose a point along that line, some combination of the risk-free asset and the market portfolio. You could be completely in the bay, or you could be completely on the dock, or some combination thereof. So that would be the capital market line. Now, beyond M on this line, you could go further than that. How would you do that? You would borrow at the risk-free rate and extend and buy even more stocks. So you'd go on margin or go on a margin account. So you could get beyond 100% of the market portfolio if you borrowed. That's why the line extends beyond that. So it also says in the world of homogeneous expectations, M is the same for all investors. Of course, we don't have homogeneous expectations. We have different expectations. So we're going to have different expected returns, which means we have a little bit different capital market line from everyone. Taking that one step further, if we look at the different points on the line, you can see here it's got several different points pointed out, and it suggests that the line really where we are on the line depends on our risk tolerance, how much risk we want to take. Do you want to take full market risk, put everything in the boats, we're in the market 100% of the time, or do we want to pull some back and leave it on the shore with our risk-free rate? That's a decision everybody gets to make for how much risk they want to take. You could even go further and go on margin and borrow money to invest in the stock market and so on. But this capital market line, the idea of the capital market line is what we want to do is have the biggest return we can get for the level of risk we're taking. Remember, returns are on the vertical axis, risk is on the horizontal axis. So we want the biggest return for the amount of risk we can take. That's what we're looking for. Because we don't want to take any more risk than we have to, but we also need to have the return that is required for whatever investment that we're making. So we want our expected returns to be high, we want our volatility to be low, and some sort of combination of the two will get us our model portfolio, or the one that gives us the best balance between risk and reward. And when you find that balance between risk and reward, that's the portfolio you should take. Now, if you're trying to get this into your own terms on your own portfolio, think of it this way. You put as much money into stocks as you want to have bouncing around in the ocean, and the rest of the money or S&P 500 index funds, and then some bonds, the combination of the two, and then the rest of the money you leave in the risk-free, so you've got some cushion in case things get really volatile. So that would be your own portfolio as a combination of cash as well as stocks and bonds. And a lot of people take the market portfolio as being just the S&P 500, and they put their stock money into the S&P 500. They don't worry about the volatility because they're dripping into it every month, and when they retire, they'll worry about the total of the two. So that's how to tie it into your own portfolio. If you have any questions on that, you can email me. And if this video goes on for years and years, you can still probably find me. But the idea of it is that you want to either put your money at risk or not put your money at risk. Make sure you're clear on that, and how much risk you take is going to be individual for your own situation.